Hello and welcome to Moneylife. This is Sucheta Dilal. Today we're going to talk about the Reserve Bank of India and banking supervision under Shaktikanta Das, who's been its governor since 2018. Mr. Das doesn't come across as a tough regulator. He's forever smiling and affable, and you would be surprised to know that when you evaluate what the RBI is doing, especially in the context of what has happened recently with Kotak Bank, you realize that this is a man with a mild exterior, but extremely tough. Here's what I have to say after analyzing the situation. So let's start with 2020. The Reserve Bank of India imposed crippling restrictions on HDFC Bank, which was then India's largest bank by market capitalization. It sent shockwaves through the banking industry because what RBI had done this time is not to just impose a monetary penalty or a stern warning. It asked the bank to stop all digital business generating activity, stop sourcing new credit cards until it fixed the recurring outages that had disrupted its operations and caused so much of harassment to customers. There were innumerable complaints going on for a long time, but this is the first time that the banking supervisor had taken such drastic action as to say, no more new business, fix things first, we will audit it, and only then can you restart. So there was a partial relief in 2021, and the restrictions are finally lifted only in March 2022. Now, you would have thought that if this happened to India's largest bank, then everybody ought to be on guard and realize that something has changed at the Reserve Bank of India, right? After all, over this period of time, HDFC was not alone. It's been a string of regulatory actions that you would have seen in every paper after the 24th April action against Kotak Mahindra Bank. Yet, when the RBI imposed nearly identical restrictions on Kotak Mahindra Bank, it again surprised investors and the stock price crashed. Customers were equally surprised. Why would this happen? Is it because the harsh wording of RBI's press release? Or is it because action against Uday Kotak, who was the NDA government's go-to person for any problems that they had, was not expected? Mr. Kotak, remember, headed SEBI's Corporate Governance Committee. He was the person that the Prime Minister called when he wanted to sack the board of ILFS and set up a government-appointed board to try and salvage this large conglomerate that had created a systemic issue in the financial sector. Kotak Bank was also the only one ever to have taken on the RBI and filed a lawsuit against its regulations about dilution of promoter equity at the end of December 2018. This was just shortly after Mr. Das had become the governor. Now, was the RBI action retaliation for Kotak Mahindra Bank's temerity to sue the regulator? Some people have been alleging that, but I would urge that let's look at the whole thing more holistically. When Shaktikanta Das took over as governor in December 2018, he inherited a giant mess. Not only had Kotak sued the RBI, but the collapse of this 341 giant conglomerate, Hydra-headed conglomerate as we call it, ILFS had caused such a systemic shock. This was exacerbated by the collapse of Yes Bank, Diwan Housing Finance, huge fraud over there. Punjab and Maharashtra Cooperative Bank again collapsed due to another branch of the same family, which was HDIL, Housing Development and Infrastructure Limited. Then Lakshmi Vilas Bank went belly up. In each case, RBI was not only caught off guard, but found lacking in tough and timely action. In fact, in ILFS, the Serious Frauds Investigation Office, for the first time ever, actually pointed a finger at the regulator and accused RBI of failing to act in time, which in fact it did. There are plenty of reports to show that. After the PMC Bank debacle, the government had to appease people. It increased deposit insurance and it ended dual regulation on cooperative banks. So since then, RBI is solely responsible for supervising cooperative banks, which fail with extraordinary regularity and are usually run by shady politicians. Now, this further increased the burden on the Reserve Bank of India. Here's what it had to regulate. As opposed to, say, 12 public sector banks now shrunk after the mergers, 21 private banks, 6 payment banks, which are too tiny and except for Paytm, inconsequential, 44 foreign banks, of which really only 2 are big deposit takers. Others don't have much in terms of deposits. The number of cooperative banks is 1,902. These include state cooperative banks, district cooperative banks, regional rural banks, and urban cooperative banks. They also include local area banks. Now, RBI has been constantly on the case of these banks, and Moneylife is the only publication. If you go online and read what we say, Moneylife is the only publication that has been reporting RBI action against these banks on a daily basis. And almost every day, 2 or 3 banks are being pulled up and fined for not following the rules. Another major challenge to the RBI in the same period has been the rapid growth in technology and the explosion of online transactions. Now, we celebrate this, the fact that we can transact easily. And the number of online transactions have just zoomed after the COVID pandemic because we were all sitting at home and that's the only way we could make payments. But if Kotak Mahindra and HDFC Bank are finding it tough to deal with the pressure of this explosion of online transactions, think of the RBI. It is supposed to regulate them. That means it has to understand technology, check what is wrong, and then act. And if there is a systemic failure, or if something goes under because of a fraud or a technical failure, frankly, the buck stops at the RBI because we will all turn around and say, what on earth was the RBI doing? Now, Mr. Shaktikanta Das's predecessors, including rock star economists, former bureaucrats, gold medalists, all of them got away by focusing primarily on monetary policy and ignored supervision. They ignored big bank defaults, but he did not have that luxury. It was a tough initial period. Lessons were learned. The defaults led to the collapse of organizations. Loans were being written off in a big way. And from each fiasco, there's been a lesson and action. Action has been relentless despite pushback and pressure from powerful regulated entities. Remember, the financial sector is very powerful. After the action against Kotak Mahindra Bank, most publications have published a laundry list of actions that RBI has been taking since 2020. They include the Paytm Bank, Bank of Baroda's scandalous payment app where its officers were given targets and they were putting their own numbers, India Infoline Finance, IIFL Finance that is, JM Financial Products, Bajaj Finance, Mahindra Financial Services. Each one of them has been told to stop more onboarding of customers until they set their systems right. None of them have liked it, but they have to comply and fall in line. It's important to examine RBI's supervisory actions more closely. Very evident that the RBI is tougher than before. In the past, inspection reports by its officers used to get systematically diluted as they moved hierarchy and eventually lead with a meeting with the CEO and maybe a small slap on the wrist. Nothing much. The country has paid a huge price for this laxity, as is clear from the fact that 14.56 lakh crore rupees have been written off by public sector banks alone in the decade between 2014-15 and 2022-23. The recovery is a tiny 14%. This could not continue because all this was made good by the exchequer from public money, which should have been used for education and health and facilities and infrastructure. All this was covering up the defaults of big industrialists, right? Not for the poor, not for farmers. Now, the best way to understand the situation is by asking, when was the last time that the RBI has initiated such tough action against so many banks and regulated entities in a short span? The answer may surprise you. It goes back 30 years, to 92, 93, after the securities scam, or what was then called the Harshit Mehta scam, but it was mainly in banks and government securities, which engulfed the entire banking and financial sector, and a variety of shady practices, or what was called cowboy banking, came to the surface. The establishment of a joint parliamentary committee supported by a multidisciplinary investigation committee headed by the RBI, which included the CBI, income tax, and others, led to a series of reports and a crackdown against every aspect of the financial sector that was up to mischief. Consequently, a couple of small private banks had folded up. New rules led to large-scale closure of non-banking finance companies, leasing companies, which were very popular at that time. All this action was separate from the criminal action and lawsuits initiated by the Central Bureau of Investigation. The CBI cases continued to drag on in the special court that was set up in 92 for the trial of scam-related offenses. Now, importantly, RBI's punitive action, especially against foreign banks, even those days, was limited to a monetary penalty and a change in top management. I asked several senior bankers, most of them refusing to go on record, have you ever seen this level of action after that phase? They have not. It has happened now between 2020 and 2024. So what is the big change and reason for it? The change is at multiple levels. One, RBI's transformation is evident in how it handled the bank failures. So these are the ones I told you that Shaktikanta Das inherited when he became the governor. Previously, the typical approach was a shotgun wedding with a public sector bank. A good public sector bank was loaded with all the problems of a bad bank that collapsed. This has not occurred again under Mr. Das's watch. In fact, when Yes Bank collapsed, sure, State Bank of India did come in as a big contributor because that was typical RBI thinking even then. But private banks were asked to chip in and share a part of the burden. Even at that time, there was internal resistance in the RBI to allow foreign portfolio investors to bring in some money, though they were very keen to do it. And I think, and I've written that it was a mistake. But when Lakshmi Vilas Bank collapsed, RBI took the next step, brought in DBS Singapore, and it was a much neater and quicker resolution without a lot of hand-wringing about who is going to bail out this bank and where will the money come from. PMC Bank was significantly messier. First, it was cooperative bank, and that too has been partially resolved. Now, in cooperative banks, people have to remember that because they were politically driven, because there was dual regulation, the usual RBI way was to ignore the problem and do a cop-out saying the registrar of cooperatives is also responsible for regulation. Then there are always politicians putting pressure. So the bank is just allowed to sink. People don't get their deposits back. And after many years, they would fob off depositors with 1 lakh, which was the deposit insurance guarantee, and then close the bank. They got just 1 lakh. This was not done in PMC Bank. Remember, that was PMC Bank was a turning point. Deposit insurance was raised to 5 lakhs. And this was the last time that this method of just ignoring them, maybe because the public outcry was so huge, because it was seen as an extremely well-run bank, and nobody knew the enormous fraud that was going on, which many of us think that RBI inspection reports ought to have caught. There's another way in which RBI is always walking on the razor's edge. Although deposit insurance is raised, the danger of social media rapidly amplifying potential financial failure has increased in a big way. This means that regulators no longer have the luxury of imposing a moratorium and suddenly saying no deposits can be withdrawn. Because today, things just spread like wildfire on Twitter and WhatsApp and social media. And in minutes, you can use your phone and withdraw your deposits, transfer them to another bank. And in fact, this action itself, this panic, sometimes even false panic, can trigger a bank collapse. And this is not hypothetical. It has happened in March 2023 with Silicon Valley Bank of the US. In fact, the bank collapsed in exactly 48 hours because scared depositors withdrew a staggering $42 billion in just 2 days, 48 hours. This was 25% of the total deposits of the bank. And guess what? The bank needed just 2.25 billion to shore up its balance sheet. This collapse has been called a Twitter-fueled bank run. And believe me, it can happen again and again. It could easily happen in India, where everybody has a phone. Tech outages already caused panic among customers. It happened with Kotak Mahindra Bank on 15th April. In fact, perhaps that precipitated the RBI action. It had used to happen frequently at HDFC Bank until the RBI acted on it. ICICI Bank faced a big glitch on 24th April. 17,000 new credit cards were mapped to wrong users. Fortunately, it was fixed very, very quickly and contained without losses. Now, internal fraud is another threat. The internal fraud could be bank employees. It happened in United Commercial Bank, where 2 engineers have committed a fraud. In fact, a CBI investigation discovered that fraudulent engineers had created 820 crores of money out of nowhere by manipulating the systems electronically. They credited this to 14,600 accounts in 6 private banks without debiting any originating bank. The CBI has then raided and cracked down on these people and has been trying to recover money. It can happen again and again. The solution is to hit banks where it hurts so that they understand the seriousness and gravity of falling in line and complying when the RBI says, we find that you're not up to the mark. Given the high risks, RBI has no choice. So barring banks and financial entities from onboarding new customers until they fix their system is the only way. Why? Because it imposes reputational damage, it impacts financial performance. This in turn directly affects the performance evaluation of the CEO and the top team. Remember, they get the maximum money, and ESOPs. It affects the value of those ESOPs. It affects investors. It leads to an immediate impact on the stock price. This means that there's a greater sense of urgency in ensuring compliance. There are no excuses. They do invest in appropriate technology and talent to plug every loophole that's visible. In fact, former Deputy Governor R. Gandhi says, when penalties did not bite financially and regular action led to no dent on reputation, RBI had to think differently and make its actions effective. Parallelly, banks became fully digital, and any correction of regulatory violation needed a system-wide impact. It's clear that this is working well and needs to be imbibed by other regulators as well. But the transition in supervisory action, remember, is not easy. Private banks have a lot of political clout. The new age fintech companies are even more powerful. We saw this in action when fintech leaders ganged up in support of Paytm Bank, went and complained to the finance ministry that the RBI did not understand the sector. It's lucky that the finance ministry stood by the RBI, and these fintech leaders ganged up in spite of ample evidence that Paytm had failed to read the seriousness of RBI's warnings for 4 years. In fact, first action on onboarding customers was taken as far back in 2018. Drastic action came only this year. When his term ends, affable Mr. Shaktikanta Das may be remembered as the toughest and most effective governor in recent times, overseeing drastic changes in technology and financial landscape amidst a once-in-a-lifetime global pandemic. Now, nobody really likes a tough governor, especially one who doesn't look so tough, and people make up all kinds of stories about whether RBI is being unfair, whether it's targeting anyone. But look at it holistically, as I have done in this video blog, and there is a clear pattern. And believe me, if the RBI is not tough, we really have something to be concerned about, and it is our money that can vanish in a jiffy. If you agree with this, please share this video and subscribe. Thank you.